Every day, a single number decided how much you paid on your mortgage, your student loan, your credit card. That number wasn't set by a government. It wasn't set by a market. It was quietly decided by a handful of bankers, who later admitted they were lying. This is the LIBOR scandal. This is Fraudify, where we unmask the world's biggest scams. LIBOR stood for the London Interbank Offered Rate. It was supposed to be the most trusted interest rate in the world. Instead, it became the most manipulated. This is a Fraudify investigation. LIBOR wasn't a small financial metric. It controlled mortgages, corporate loans, student debt, credit cards, derivatives worth over $350 trillion. If LIBOR moved even slightly, billions changed hands, and almost nobody understood how it was calculated. That ignorance became the perfect cover. Every day, major global banks were asked one question. At what rate could you borrow money from another bank today? They didn't have to prove it. They didn't have to execute a trade. They just submitted a number. Those numbers were averaged. That average became LIBOR. There was no verification, no real oversight, and no transaction required. The system relied entirely on honesty. That was the flaw. Inside banks, traders held massive positions tied to LIBOR. If the rate moved up or down, even by a fraction, they could make or lose millions. Soon, traders realized something dangerous. They could influence the rate just by asking. Emails and chat logs later revealed traders messaging colleagues. Any chance you can push LIBOR down today? Need a low fixing, big position. And the requests were granted. This wasn't an isolated incident. Investigations later showed manipulation at Barclays, UBS, Deutsche Bank, JP Morgan, Citigroup, Royal Bank of Scotland. Traders openly joked about rigging the rate. One message read, "Mate, I owe you a bottle of champagne." Another, "Done for you, big boy." This wasn't secrecy. It was normalized corruption. Why didn't compliance stop it? Because the manipulation was subtle. Because profits looked legitimate. Because questioning it meant challenging revenue. And during the 2008 financial crisis, something worse happened. Banks began lying to look healthier. They submitted artificially low borrowing rates to hide signs of distress. LIBOR wasn't just rigged for profit anymore. It was rigged to survive. The scandal broke when regulators noticed something strange. LIBOR rates didn't match reality. Banks claimed they could borrow cheaply, even when markets were frozen. Investigations began quietly. Emails were subpoenaed and chat rooms were exposed. The language was unmistakable. This wasn't miscommunication. It was coordination. In 2012, Barclays became the first bank to settle. They admitted manipulation. Executives resigned. Fines followed. Public outrage exploded. But Barclays wasn't the end. It was the beginning. Banks across the world were fined over $9 billion. Traders were prosecuted. Some went to prison. Governments admitted the system was broken. LIBOR, the world's most important rate, was officially declared unreliable. A number that shaped global finance had been based on lies. Not the executives, not the institutions. The real victims were ordinary people. Anyone with a mortgage, a student loan, a pension fund. They paid interest based on a manipulated number, without knowing it. This wasn't victimless. It was invisible theft. After the scandal, regulators made a rare decision. LIBOR will be phased out, replaced by new rates, new systems, new safeguards, but the damage was done. Trust had collapsed. The LIBOR scandal wasn't about bad traders. It was about a system that trusted power without verification. A system where a few people controlled a number. That affected billions of lives. And for years, no one questioned it. This is Fraudify, where we unmask the world's biggest scams. Don't forget to like, share, and subscribe to Fraudify for more.